Hi, good evening, everyone, and a warm welcome to our FCNH webinar series. We are thrilled to have each of you here with us today. And before we begin, could you please confirm in the chat box if you can hear me clearly? Just type in yes or share an emoticon in the chat box if you are able to hear me clearly. Great, thank you very much for confirming. This FCNH webinar series is proudly brought to you by Bursa Malaysia Derivatives in collaboration with our company Excellent. Today's topic is Decoding USD CNH Currency Dynamics, Factors and Predictions. I'm Siwaiso, your moderator for today's session. We are privileged to have two speakers joining us today to share with us this informative session. I see more people have just joined the webinar room. Welcome. Before we begin, let's do one final sound check. If you can hear me, please type in 111 or yes in the chat box, or give us a thumbs up in the chat box. And if needed, please take a moment to adjust your volume settings to ensure optimal sound quality. Great. To ensure you have the smoothest and highest quality video experience, we recommend turning off your video camera during the session, as this will help everyone enjoy uninterrupted webinar and have an optimal learning experience. Today's session will be divided into three parts. The first two parts, our two speakers will give their presentation, followed by a Q&A session where you can ask any questions related to today's webinar topic. Along the way, while our speakers are presenting, if you have any questions, you do not need to wait until the end of the webinar. You can start submitting your questions in the Q&A box. We will get our speakers to clarify the questions you may have related to this webinar in the Q&A session. To ensure we can address your questions effectively, please follow these steps. Firstly, you need to find the Q&A section below and make sure it is sent to all co-hosts. This will help me capture your questions easily. And please note that due to high volume of messages in the chat box, it may be challenging to spot your questions if you don't use the Q&A box. So feel free to type your questions in the Q&A box at any time during the session. I believe some of you here may be new to futures trading, so try your best to follow today's FCNH webinar, as it will help you broaden your exposure about futures trading. We have a lineup of exciting topics ahead, which is the LRF Let's Learn Futures webinar series to help you better understand futures trading. And this also includes currency futures. Every Tuesday, we will feature a new webinar with sessions available in English, Malay, and Mandarin. Our panel of speakers will share valuable insights and practical strategies related to futures trading. So if you're interested in enhancing your knowledge and skills in futures trading, simply scan the QR code to register. So let's get started with our first presentation. It's my pleasure to introduce our first speaker, Darren Lingi. Darren serves as a senior executive at Bursa Malaysia Derivatives, where he played a crucial role in the development of currency and energy derivatives products. With over 5 years of experience in the financial services industry, Darren has built a strong foundation in this field. And before joining Bursa Malaysia, he was employed at one of Malaysia's largest investment banks, where he gained valuable insights in the futures and commodities department. So without further ado, I'm delighted to hand over the presentation to Darren. Darren, over to you.
All right. Hi, everybody. My name is Darren. I am with the product and market development team over in Bursa Malaysia. One of my key tasks is to look into new products that we can offer for the market. And we are proud to share our mini dollar and renminbi futures contract. It is Malaysia's very first exchange traded FX contract. And I'm very excited to share what we have in store today. Before I begin, I would like to put out a disclaimer, as you can see over here. I would first like to say that the settlement price of the mini US dollar versus renminbi Hong Kong futures contract traded on Hong Kong Futures Exchange Limited is used by Bursa Malaysia Derivatives with permission by HKFE. Secondly, the USD CNY Hong Kong spot rate is owned and administered by the Treasury Markets Association and exclusively licensed to the London Stock Exchange Group and its affiliates. All rights remain reserved. Let's talk about the background on Bursa Malaysia Derivatives Berhad. Our governance structure is as follows. We have a regulator on the left. You can see is Ministry of Finance, the Federal Treasury, and then followed by the Securities Commission, or as you guys will know, it's called the SC. And we are a wholly owned subsidiary of Bursa Malaysia Berhad. Fun fact, there are over 900 companies listed through Bursa Malaysia, and they are our parent company. And over to the far right, we have Bursa Malaysia Derivatives Berhad. We have the world's most liquid crude palm oil futures, also known as the FCPO, and it has been long recognized and referenced as a global price benchmark. One good thing about some of our contracts, if not most of it, is that it is traded through CME Globex, so that's also known as the Chicago Mercantile Exchange. What that does is that if you have access to CME products, you can plug in and trade Bursa Malaysia derivative products. What exactly does BMD do? So as I said earlier, we are a wholly owned subsidiary of Bursa Malaysia, but what we do is that we operate and maintain the country's only derivatives exchange. So the first thing is we offer standardized futures and options contract for you to trade across commodities, equities, currency, and financial asset classes. Orders can be matched on or off screen via negotiated block trades. And we have over 16 trading participants who can help guide you through the account opening process as well as teaching you how to trade. The second thing is we are a facilitator of price discovery. We host a centralized order book, and with that we build price transparency. What this means is that upon expiry, our prices tend to converge to the cash market, and the prices that you see on the screen, be it through whatever platform that you have in the future, it shows what the prices are when it change hands. So that's a reflection of market expectations as well as supply and demand dynamics. And the last thing that I want to highlight is that we act as a clearinghouse and a central counterparty. We alleviate settlement and counterparty risk by acting as a central counterparty for each contract which is traded with us. And what this means is that our clearinghouse will arrange for the settlement of obligations as well as margins. I would like to highlight some key notable events which happened in the month of September. We hit a new high of over 178,380 contracts in May 2020, May 2024, and our last high was 161,000 in May 2020. So as you know, May 2020 was COVID, and we are glad to see that we have hit our single daily trading volume beyond COVID. What we also like to highlight is that over in September, we have over 15.9 million of trading volume, 86.9 thousand ADC or ADV, which is known as average daily volumes, compared to last year where we had over 72.9 thousand ADV. We would also like to point out a new product that we launched this year. That is the Bursa Malaysia Dalian Commodities Exchange Soybean Oil Futures. So over in September, we have over 500 to 700 contracts which have changed hands. And this has been the trend since June 2024. As you know, our star and flagship product, the FCPO, it has been performing better than it has in the past months. We have an ADC of over 81,000, which makes it the highest monthly average in the first 9 months of 2024. For the FKLI, which is our equity index, which is the Kuala Lumpur Composite Index Futures, we still see continued vibrant performance with an average daily contract ADC of over 16,000 in September. 2 years ago, we launched Bursa Malaysia Derivatives' very first ESG-linked equity index. It is widely known as the FTSE for Good Bursa Malaysia Index Futures. And last year, we launched the country's very first currency FX futures product, which is the FCNH, which is what we're talking about today. We're still building up liquidity, and at the moment for FCNH, we do have market makers in place. What we would like to highlight is that soon we will have single stock futures coming up, as well as used cooking oil futures. So keep an eye out for those two products because we're very excited to launch them in the coming time. As for recognitions and awards, we have won close to 4 awards over the past 3 years. Over in 2020, we won the Exchange of the Year in Asia Pacific by FOW, also known as Futures and Options World. In 2021, we were the founding member of the UN for Sustainable Stock Exchange Derivatives Networks, which affirms our commitment to sustainability practices. Over in 2022, BMD was officially approved as a member of the RSPO, also known as the Roundtable for Sustainable Palm Oil, which further affirms our ESG commitments. In the same year, we were awarded with Exchange of the Year for Commodities, as well as Exchange for the Year of Sustainability for recognizing our efforts in meeting our ESG goals. Last year, we also won another award by FOW, where we also won the Commodities Exchange of the Year, as well as the Exchange of the Year for Sustainability. What I'd also like to highlight is that over in the US, we are registered under the CFTC, so that is known as the Commodity Futures Trading Commission. And over in Europe, we are recognized as a third country's central counterparty by the ESMA, so that is known as the European Securities and Markets Authority and Bank of England. Our flagship product, the FCPO, as you can see in this slide, our product accounts for 97% of global trades. So on average, we have about an average trading volume in terms of metric tons of 350 million up until 400 million. So that is roughly 5 times of leverage on global production. We are very proud to highlight that we are the very first exchange in the world to mandate sustainable certification requirements. So what this means is that we mandate certain sustainability requirements for physically deliverable FCPO contracts. Next, for our FKLI, this is our equity index, the flagship KLCI futures contract. Over 72% of those FKLI trades are done by foreign institutions. And what this does is that it allows these investors to gain exposure to Malaysia by facilitating risk management strategies by using our futures contracts. We have up to 7.6 billion in terms of daily notional trading value. So that is roughly 6 times of leverage on the KLCI index. As far as other records that we also like to highlight is that this is the very first index futures launch over in December 1995. So today, let's talk about the main focus, which is the FCNH contract. The FCNH is a mini US dollar Chinese renminbi futures contract. What this does is that it provides investors with a leverage means for you to trade your dollar and renminbi exposures by enabling you to trade the exchange rate between the dollar and the offshore renminbi. So the currency pair is the dollar, and the quoted pair is the quote is the CNH. And the size of one contract is $20,000. And this contract is settled via cash. So there's no physical delivery and there's no exchange of principal. The initial margin for trading this is 2,500 renminbi. And we accept dollars, ringgit, and renminbi for your initial margins. Here's more detail about the contract specs. So as I said, the underlying asset is a US dollar and the Chinese offshore renminbi. So I like to highlight that there's Chinese onshore and offshore renminbi. So the CNH is the offshore renminbi. The contract size is $20,000 and the price fluctuation is about 4 decimal places. So that's equivalent to 2 renminbi per tick. We have over 10 months of contracts that you can trade. It's the spot, the next 3 calendar months, followed by the next 6 calendar quarterly months. Our trading hours are as follows. All of this is in Malaysia time, which is GMT +8. So 9 a.m. to 6 p.m. And then our T+1 session is 9 p.m. until 2:30 a.m. Our final trading day is licensed from the Hong Kong Futures Exchange, so which is what I said in the earlier disclaimer. It is basically 2 Hong Kong business days prior to the 3rd Wednesday of the contract month. So to make it simple is that if you just look at a calendar and then you see the 3rd Wednesday, you minus 2 days from that, and then that will be your final trading day. And the settlement is in renminbi on the final settlement price. So we want to show how settlement works. And in this example, I want to just show that we are assuming that the investor is holding the position up until expiry, so which is the final settlement. And we're assuming that you're going long. So as I said, the contract size is 20,000. So what that means is that one contract allows you to get exposure to up to $20,000. So say your entry price is 7.0536 RMB. You multiply that by the contract size, which is $20,000, and then that will be your value. Which is, that's your value at the point of entry. So say you wait X amount of days and you're holding it all the way up to expiry. So what that does is that what we'll do is that we will calculate the dollar renminbi spot rate, which is administered by the Hong Kong Treasury Markets Association, and say that rate is 7.5748. You would do 7.5748 multiplied by 20, and then you get your price, which is 151,000 renminbi. So to calculate your profit and loss, you just do value at settlement, and then you minus your value at position of entry. So final price minus entry price, and then that will be your profit and loss. But I do want to stress that this profit and loss, it does not include any brokerage or any additional charges, because that will vary based on which broker that you would choose to trade with. For those of you with access to these terminals above, this is how you can have a look at our contract. On CME Globex, it's BMD/FCNH. On Bloomberg, it's UCPA, and then you just press F11, I think. Currency, yeah, and then you just click go. LSEG Workspace, aka Refinitiv, FCNH, month code and year code, and the codes are standard for futures contracts. And for those of you with access to ICE, the instructions to access it are as follows. If you're interested in opening an account to trade FCNH and our other products, feel free to approach any of our TPs as listed above. We are proud to highlight that we have two new entrants to the market. We have Weibo Securities as well as Mumu. So feel free to approach any of them. If you need help, you can email us at futures@Bursa Malaysia, and then we can help you with the account opening process. So that's all I have on my end. Thank you guys for listening, and I'd like to pass the floor back to CY.
Thank you, Darren, for your informative sharing about the FCNH currency futures contract. Next up, our next session will be presented by Aaron Gauchi. Aaron is currently a senior financial market analyst at the Global Market Divisions of Bank of China, Hong Kong. Aaron brings 17 years of experience in macro, interest rate, and foreign exchange market strategy analysis, having worked at Scotiabank, Royal Bank of Scotland, and BNP Paribas. He holds the Financial Risk Manager (FRM) certification and has dual master's degree in Financial Engineering and Computer Control and Automation from Nanyang Technological University, Singapore. Without further ado, I'm delighted to hand over the presentation to Aaron. Aaron, over to you.
Good evening, everyone. Thank you all for joining us tonight. I'm Aaron from Bank of China, Hong Kong. I'm honored to be here to share our latest view regarding global FX market, particularly dollar CNH currency pair. So let's start with introducing global market overview. As we know, FX market is the world's largest and most liquid financial market. According to a BIS survey conducted in April 2022, the daily trading volume averaged is about $7.5 trillion US, with FX spot and FX swap accounting for 28% and 51% respectively. FX market operates 24 hours, 5 days a week across major financial centers, including London, New York, Tokyo, and Sydney. As we know, there are G7 currencies, which include dollar, euro, yen, sterling, Swiss franc, CAD, and Aussie. So if add another three, Kiwi, NOK, SEK, we will get G10. The rest are emerging market currencies. According to market information, we note there are different kinds of participants in FX market, which include central banks. Central banks typically manage currency stability and foreign reserves. There are also commercial banks, which facilitate transactions for customers. There are corporations as well that conduct cross-border transactions for business needs. and we have institutional investors in FX market. They engage in speculation and some carry trade. Their turnover account for about 7% of total turnover, and there are also retail investors. Retail investors are individual investors using brokers to speculate on currency movement. So the right-hand side, the two charts from BRS survey, which showed the FX spot accounted for 28%, FX swap accounted for 51%, and the institutional investors turnover account for about 7% of the total turnover. So now let's talk about how the FX market works. So in general, as we know, currency are always traded in pairs. So if we say we want to buy a euro US dollar, which means buy euro and sell US dollar, according to BI survey, and the currency transactions involving US dollar account for roughly 90% of total transactions, and among which euro US dollar currency pair account for 23%. So dollar is the most frequently traded currency, and the euro dollar is most frequently traded currency pair. And as similar to other market, their bid-ask spread in FX market is the difference between buying and the selling price. So we have a lower part chart which show the bid price and the sale price, and also we can call offer. So we can see for emerging market currencies, the bid-ask spread is slightly wider than the G10 currencies because of liquidity is different. So there's also a leverage because FX market is different from, for example, stock market. So in stock market, we can have a 5% change, 10% change, or even much more than that. But for FX market, so 1% or 2% change, a daily change is not small. So investors or speculators, if they want get money from the market totally, they can use leverage. So they can use with small capitals to control large positions. There are also spot and forward market. Spot transactions are closed immediately, while forward contract for future transactions. And yes, similar to other financial products, there are many factors which can affect FX market. The first of all is called economic indicators like GDP, inflation, employment data, trade balance, current account balance. So this one we also call fundamentals. There are also policy side factors, monetary policy. Typically, higher interest rate attract foreign investors, increasing demand for the currency. And there are also political and geopolitical events like elections, the upcoming US presidential elections, policies, fiscal policies, geopolitical tension, and some natural event. So we also pay attention to market sentiment and positions, like whether it's risk on or risk off. And if there's escalated risk aversion in the market, safe haven currencies will be chased, which include US dollar, yen, and the Swiss franc. So, and now we are going to talk about some regimes and risks in exchange rate market. So in general, there are three types of exchange rate regimes: floating, fixed, and managed floating. So for floating, is most of the G10 currencies that they have floating exchange rate regimes like US dollar, euro, sterling, yen, and there are fixed exchange rate currencies like Hong Kong dollar pegged to US dollar, Hong Kong dollar traded between 7.75 to 7.85, like Brunei dollar, which is pegged to Singapore dollar with a 1-to-1 ratio. They also managed floating currency like Indonesian rupiah. So on the upside, the up part chart, so managed floating and clean floating, they call flexible exchange rate. And when we trade in FX market, we also need to pay attention to some risks, which include exchange rate risk. Currency fluctuations can impact the profitability of international transactions. There are also interest rate risk. So the change in interest rate can alter currency demand and affect portfolio P&L. There are liquidity risk. Thinly traded currencies may experience large price swings, and there are political risk like government instability or policies, and whether it's favorable or unfavorable, both can cause a drastic currency movement. There are also geopolitical risk. A geopolitical situation could move currency sharply. And for a fixed exchange rate, sometimes the central bank or monetary authority may have to step in to keep that. Once they are intervened in FX market, they will impact local currency liquidity in the market. So then most central banks, after intervening in FX market, they will use different fixed income products or policies like central bank bills, government bills, or reserve requirement ratio to sterilize to make the liquidity impact neutral. So now let's move on to some exams, total 11 exams, to explain the different factors impact on FX, on exchange rate. The first one is Japan earthquake and the tsunami happened in 2011. So on 11th March 2011, the earthquake happened in Pacific Ocean, 72 kilometers east of the Oshika Peninsula. So it lasted approximately 6 minutes and caused a tsunami. So we can see on the chart, we can see from the 11th March, so within 5 trading sessions, dollar yen dropped roughly 9%, 8.5%, 8.5%. And this has some negative impact on Japan's economy. So on 18 March 2011, group of 7 nations, G7 nations, jointly intervened to stem the yen strength when the currency spikes to a record high. So we can see after the joint intervention start on 18th of March, so after several trading sessions, the dollar yen jumped 8.5%, 8.5%. So this chart shows the impact of a natural event and the FX intervention. That's an interesting question is why there's an earthquake happening in Japan, the yen appreciate rather than depreciating. It's because of Japan's low yielding environment. So Japan's insurance company, they invest a lot of funds in overseas market for higher yielding return. So once the earthquake happened, they have to sell overseas assets, then repatriate the funds to Japan to pay for claims. So that's why when natural event happened in Japan, the yen, Japanese yen appreciate rather than depreciating versus US dollar. The second one is regarding central bank policy. It's the SNB floor in 2015. So as we know, SNB, the Central Bank of Switzerland, introduced 1.2 euro Swiss franc floor on 6 September 2011 in order to stabilize the Swiss franc at a level that was bearable for the economy and avoid deflationary spiral. So, however, at that time, the euro faced very strong downward pressure, and finally, on 15th of January 2015, Switzerland Central Bank SNB removed the exchange rate floor of 1.2 on the value of the euro versus Swiss franc. So from the chart, you can see on a single trading day, so euro Swiss franc even dropped 29%, a very huge movement. So it explained the impact of central bank policy movement on exchange rate. The third one is regarding central bank policy as well, and it's happened in 2015, August 2015. So on 11th of August 2015, China's central bank reformed dollar CNY fixing formation mechanism. It's the fixing also called central parity system. So effecting beginning on 11th of August 2015, the daily dollar CNY fixing should be based on the closing rate of the interbank FX rate market on the previous trading session, supply and demand in the market, and the price movement of major currencies. So on this chart, we can see before there's a reform, so dollar CNY spot, so trade in a very narrow range, very narrow range. So on that day, 11th of August, we can see dollar CNY spot just jumped about 2%, then jump another 1.8% on the second trading session. So it also suggests the impact of central bank policy shift is relatively big. So the fourth example explains the political events impact, which is Brexit. Brexit was the withdrawal of the United Kingdom from the European Union. The referendum held in the UK on 23rd June 2016. Brexit officially took place at 11 p.m. GMT on 31st January 2020. So the referendum was held on 23rd of June, but the result was released on 24th of June. So we can see on 24th of June, sterling dollar just dropped about 12%, just within one single day. So it's also a significant movement. And until now, sterling dollar still traded way below 1.5 level. The fifth example is about pandemic. So given the coronavirus outbreak in 2020, the market initially expected the Fed to lower its benchmark interest rate, which pushed the dollar index lower from late February to early March 2020. Then after that, the severe situation escalated flight to quality demand that boosted the dollar index in early to late March. And on 23rd of March 2020, the Fed launched unlimited QE, which calmed the market and weighed on the dollar index accordingly. So we can see when the market expected the Fed to cut the policy rate, dollar index just dropped continuously. Then once market realized, the pandemic situation is important, is severe, then we can see a flight to quality demand just pushed dollar index substantially higher. On 23rd of March, the Fed announced the unlimited QE. Then the dollar index dropped, then keep falling. So it suggests, first of all, when market expects central bank to cut policy rate, currency will depreciate in general. When there's the flight to quality demand, the safe haven currency will appreciate, like US dollar, like Japanese yen, like Swiss franc. So once the central bank announce unlimited QE, quantitative easing, the currency value will drop versus its peers. So the sixth example is about central bank policy as well. So as we know, the Fed hiked interest rate total of 11 times between March 2020 and July 2023. So this made borrowing more expensive to fight against inflation. So all major central banks, except Bank of Japan, raised benchmark interest rate in the cycle. From the chart, we can see U.S. CPI inflation is a leading signal, leading indicator, which start to rising in first quarter of 2021. Then roughly after a quarter, dollar index start to rising. Then we have Fed start to raise policy rate. At that time, it suggests the Fed was behind the curve. So yeah, the CPI inflation is a leading indicator. So we keep watching on that. The seventh one is regarding interest rate spread. Interest rate spread refer to the difference in interest rates between two current countries. Higher interest rates in one country typically attract foreign investors seeking better returns, increasing demand for that country's currency. As a result, currencies from countries with higher interest rate often appreciate relative to those with a lower interest rate and vice versa. So sometimes they are a carry trade. Investors, they just borrow in low yielding currencies to invest in higher yielding ones. So we have two currency pair here. The up one is Euro US dollar. We calculated the 2-year US Treasury yield and the 2-year Germany government bond yield spread. So we can see there's a tight correlation between the currency pair and the government yield spread. The low part is dollar yen spot. We calculate the 10-year Japan government bond yield and the 10-year US Treasury yield. There's also a similar close correlation between the currency pair and the 10-year bond yield spread. Now let's move to carry trade. As we just mentioned, the carry trade means you borrow in low yielding currency and investment in high yielding currency. And this part, in fact, also shows the impact of FX intervention. So as we know, during the hiking cycle, Bank of Japan just keep a commodity monetary policy. So investors just borrow yen and buy dollar assets. So dollar yen keep rising. Then to a certain level, Bank of Japan think, okay, it's too higher. So there's 4 interventions this year happened on 29th of April, 2nd of May, 11th and 12th of July. So the Bank of Japan sold about 78 billion US dollar, 25 billion US dollar, and 37 billion US dollar, respectively, on 29th of April, 2nd of May, and the 11th to 12th of July. So we can see once the Bank of Japan intervened in the market, dollar yen just dropped because they sell dollar yen in the market. So then on 31st of July, Bank of Japan raised policy rate by 15 basis points. So the higher policy rate boosted demand for Japanese yen. Dollar yen traded even lower. The ninth example is about fundamentals called current account balance. So from the chart we see the dollar peso runs a close correlation with the nation's current account balance in terms of percentage of GDP. So current account refer to a country's balance of payments that track its transactions with the rest of the world, excluding capital and financial transfers. So in FX market, the chart just showed a current account balance can influence the exchange rate. Typically, as surplus could strengthen the currency and a deficit will weaken the currencies. This one is about currency central bank policy as well. So this chart is a bit interesting. As we just mentioned, generally speaking, when central bank hike policy rate, currency will appreciate. When central bank cut policy rate, the currency will depreciate. But it will depend on fundamentals. On these two charts, we note on 24th January and 24th of September, PBOC governor announced both R cut and the interest rate cut. We can see the chart. After the PBOC governor announced monetary easing measures at the press conference, the dollar CNH dropped. It means CNH appreciate. So it seems different from what we just mentioned. It's because at this time, market believe in the monetary easing measures will help improve China's fundamentals, will lead to economic recovery, and will strengthen economic growth. So that's why even it's monetary easing, it's a R cut, it's interest rate cut, dollar CNH dropped, the CNH appreciated versus the US dollar. So it's interesting. So we just bear in mind, in general, higher rate, higher exchange rate, but there are some different scenarios. So if the monetary easing can boost fundamentals, currency will appreciate. The last example is regarding seasonality. It's also interesting. We put two interesting charts here. So we just focus on the December, the last column of each chart. So over the past 20 years, Kiwi CAD rallied 17 times in December, which could be explained by the holiday season and the weather. New Zealand in the southern hemisphere experienced summer during this time, and in December, which could boost tourism and exports, positively impacting the Kiwi. Meanwhile, Canada is in winter and it's very, very cold. So possibly the weather difference boosts Kiwi and CAD in December. Then for this one is Kiwi CAD. This one is dollar index. For dollar index is also there's also some seasonality. So over the past 12 years, dollar index weakened 10 times in December and then rallied 9 times in February. In February is also very interesting. Based on our calculation, unless the market worry about Fed rate hike, you can see Fed, in fact, at that time, 2016, 2014, market worry about Fed tightening. So dollar appreciate most of the time, and because of the holiday season, dollar tends weaken, and dollar index tends trade lower. So it's an interesting part. It provides some trading opportunity for investors. So now we would like introduce some technical analysis basics. So we list 4 technical indicators here. The first one called RSI is Relative Strength Index. So RSI is classified as a momentum oscillator, measuring the velocity and the magnitude of price movement. RSI is most typically used on a 14-day time frame, measured on a scale from 0 to 100. So with high and low levels marked at 70 and 30 respectively. So this one is a red one is 70, the green one is 30. So if the RSI or for example, this is dollar CAD spot, this is the 14-day RSI of dollar CAD spot. Once the RSI touch 70 level, we call it overbought. It's overbought. Then there could be a correction, technical correction, dollar CAD will trade lower. So if it hit the 30 level, we call it oversold. Oversold, then we can see the spot will rally accordingly. So I think it's a useful indicator, technical indicator. The second one called MACD, moving average convergence and divergence. It's in fact it's moving. It's called moving average. Moving average. First of all, we calculate the MACD line, the blue one, the MACD line. We use 12 emerging market. We use 12 moving average minus 26-day moving average, got MACD line. Then we use 7-day moving average of MACD line, got a signal line. So we can see once the signal line cross above the MACD line, we can see it's a buying signal. So once it cross that below that, it's a selling signal. So there's other technical analysis tool. It's called Ichimoku Cloud. It's a Japanese technical analysis tool. So there are 5 lines called Tenkan Sen and Kijun Sen, Senko A, Senko B, and Kumo. It's a Kumo Cloud in Japanese language. So this one provides some resistance and support levels. So Ichimoku Cloud most used for any dollar yen or yen cross trading. We would like to introduce Fibonacci retracement. Fibonacci retracement is a method of technical analysis for determining support and resistance levels. It's named after the Fibonacci sequence of numbers. So Fibonacci retracement forecast is created by taking two extreme points, the low point, the high point, on a chart and dividing the vertical distance by Fibonacci ratios. 0% is considered to be the start of retracement. 100% is complete reversal of the original price before the move. So common levels between the 0 and 100 is 23.6, 38.2, 50, 61.8, and 76.4%. All these levels, you can see it provides some either resistance or support. Resistance or support, resistance, support. So that's the value of Fibonacci retracement. So now we will like show some patterns. If we look at the chart, of different financial assets, not only FX. We can also use this for stocks or commodities. There are three kinds of patterns: a reversal, continuation, or bilateral. Bilateral means after the pattern, the curve can either move up or move down. So continuation patterns means the trend will continue, and the reversal patterns important means the trends will be totally different. We also have a candidate pattern. It's also a Japanese analysis tool. So we have bullish patterns, we have bearish patterns, which once we find the pattern on the chart, it may provide some signal of buying or selling. So now let's move on to the second part, the impact of Fed monetary policy. First, generally speaking, as we just mentioned, when the Fed hike policy rate, dollar tends to advance. When the Fed cut policy rate, dollar tends to depreciate. So here we put a dollar CNH chart, dollar CNH versus 10-year US Treasury yield and the CGB Chinese government bond yield. You can see before early 2022, most of the time Chinese government bond yield was higher than 10-year Treasury yield. Then after that, Treasury yield, US Treasury yield keep rising. We saw this inversion because Chinese government bond yield is lower than US Treasury yield. So, but if we take the spread between these two and plot this against dollar CNH, we can see there's close correlation between the dollar CNH spot and 10-year Treasury yield spread. And in addition, based on the one called interest rate parity, we found there's close correlation between the yield spread and the forward points. So we calculate the 1-year Treasury yield and the 1-year Chinese government bond yield. We get the spread. Then we plot that versus 12 months dollar CNY is onshore. Dollar CNY 12 months forward points. We can see that's a correlation. It's determined by the so-called interest rate parity. Here we will compare dollar CNH versus dollar yen. In general, both dollar CNH and dollar yen currency pair rise when the Fed raises its benchmark interest rate to fight against the elevated CPI inflation. The yen carry trade is pretty popular, and the Japanese retail FX traders, Mr. Watanabe, are well known in the world. And also this year in January, Japan rolled out a new NISA mechanism to encourage Japanese household to invest in in financial market. But as Japan's, generally speaking, Japan's financial market is low-yielding market. So if the investors, similar to insurance companies, the individual investors also intend to sell yen to buy high-yielding assets in other nations like US, like Australia, like Kiwi. So it's called carry trade. And we can see there's a correlation between dollar yen and non-commercial net position. It's also, we can see it's a speculative position regarding dollar yen. So there's tight correlation between these two. And if we compare dollar CNH versus dollar yen, yes, we can see they move at the same times. However, there's difference is PBOC has committed to keeping the yuan exchange rate basically stable at a reasonable and balanced level. So when both dollar CNH and dollar yen increase amid Federal rate hiking cycle, we can see Chinese yuan appreciate versus this is CNH yen cross. We can see Chinese yuan appreciate versus Japanese yen. It's because PBOC said it will keep the yuan exchange rate basically stable. So Chinese yuan just depreciate less compared to Japanese yen versus US dollar. So here we will discuss about Fed, Bank of Japan, PBOC monetary policy. Generally speaking, the Fed hasn't employed an NIRP, negative interest rate policy, hasn't purchased equity ETFs. So it did lower fund Fed funds rate target range to 0.0 to 0.25%. It also inject liquidity to the system through different funding and lending facility as well as quantitative easing. After the pandemic period, it starts rate hike in March 2022 and begins the balance sheet reduction in June 2022. Last month, Fed has launched a rate cutting cycle, but the quantitative tightening continues. In Japan, Bank of Japan has employed negative interest rate policy (NIRP) and purchased most of the financial products, equity, the bonds, REITs, equity ETFs, and Bank of Japan launched rate hike cycle in January and raised the policy rate again at the end of July. I think it will continue rising policy rate, but it will select a good time window carefully to avoid another Black Monday, as what happened on 5th of August. And now the QQE continues. In China, it's a bit different. There's no negative interest rate policy, and China's central bank has maintained a normally upward sloping yield curve. Means there's no inversion. The longer term bond yield is higher than short term bond yields. China's benchmark interest rate remain positive, and there's a difference is China has a RRR, reserve requirement ratio. Now the average reserve requirement ratio in China's banking system is 6.6%. Before the September cut, it was 7%. And as just mentioned, CGB yield curve is normally upward sloping. And as we know, on 24th of September, People's Governor Pan announced the Chinese Central Bank will create two monetary policy tools to support the stock market. The first one called Securities Funds and Insurance Companies Swap Facility, SFISF. The second one called Lending Facility for share buybacks and the shareholding increase. The first one allow these financial institutions to get treasury bonds or central bank bills with some low credit rating fixed income products, and the funds raised from the treasury bonds and the central bank yields can only be invested in stock market. The second one, lending facility, is PBOC encourage commercial banks providing loans to corporates to buy back their shares or increase their shareholdings. So these two have improved China's stock market sentiment substantially, particularly in the last 1 week before the Golden Week national holiday. And on the right hand side, we just put two charts. The upper one is benchmark interest rate for Fed, Bank of Japan, PBOC, called Fed funds rate, target rate, and 7-day repo rate. Now we can see the Fed has started a rate cut cycle. Bank of Japan launched a rate hike cycle, and PBOC maintains a pro-growth policy stance. And the lower part is balance sheet total asset size for Fed, Bank of Japan, and PBOC. So as of now, the balance sheet size for these three central banks is $7 trillion, $5 trillion, and $6.5 trillion respectively. Okay, now turning our attention to the third part, CNH exchange rate outlook. First of all, let's give a brief introduction to China's onshore FX market. As we know, China's onshore spot dollar CNY has to trade between plus minus 2% around the fixing. So this is the up bound, is a low bound, this is the fixing announced by PBOC at 9:15 a.m. Beijing time each trading session. So the width is 2% on each side. So once there's some if there's some depreciation pressure, dollar CNY may trade around the upper bound, and once the dollar CNY strengthened, CNY strength, dollar CNY will drop to around the central level, the fixing level. So, and earlier in the year of 2014, 2015, we can see dollar CNY spot trade close to the low bound, means a very strong expectation for yuan to appreciate. The trading time is 9:30 a.m. to 4:30 p.m. and 4:30 p.m. to 3 a.m. on the next trading session, which called evening trading hours, starting from 3rd of January 2023. But the closing price still use the one at 4:30 p.m. as the trading session's closing price. On trading volume in the first 8 months this year, average daily FX spot and FX swap trading volume in China's onshore FX market is $54 billion and roughly $100 billion respectively. Some major factors to move dollar CNY include FX policy. The first is dollar CNY fixing, as we just mentioned, is announced by PBOC every trading session, and the FX deposit reserve requirement ratio, which is imposed on the foreign currency deposit, and FX risk reserve ratio for forward sales. So now it's 20%. If banks want to sell dollar in forward market to clients, they have to pay that. And there's a limit of outstanding cross-border financing, so you can only borrow this certain amount funds from overseas. And monetary policy. So monetary policy, we are, as we just mentioned, when the PBOC cut policy rate, market expected will boost China's economic recovery. So the yuan appreciate, and also monetary policy movement could impact U.S.-China interest rate spread. The capital flows could move current account balance, direct investment, portfolio investment, and the geopolitics like U.S.-China bilateral ties. So for offshore market, so we will give some color regarding offshore renminbi liquidity pool. At the end of 2023, renminbi deposit in major offshore markets about 1.54 trillion Chinese yuan, among which Hong Kong account for about 940 billion Chinese yuan, roughly 60%. Then at the end of August 2024, renminbi deposit in 4 offshore markets, Hong Kong, Taiwan, Singapore, UK, reached about 1.52 trillion renminbi. Hong Kong account for roughly 1 trillion, account for 66%. At the end of first quarter this year, outstanding renminbi loans extended to overseas borrowers by China's domestic institutions is about 1.4 trillion Chinese yuan. At the end of the first quarter, offshore renminbi bonds, excluding certificate of deposit, stood at roughly 1 trillion Chinese yuan. And in the first quarter, the issuance is about 200 billion Chinese yuan. So here we list some indicators and was to watch for dollar CNH spot. So for dollar CNH spot, first of all, dollar CNY spot and fixing is important. So as we just mentioned, dollar CNY has to trade between plus minus 2% around the fixing, but there's no such restrictions on dollar CNH spot. So if there's a strong expectation for appreciation, for Chinese yuan appreciation, dollar CNH will trade lower below dollar CNY. If there's some worry about Chinese yuan, dollar CNH will trade higher above dollar CNY spot. So the spread between dollar CNY spot and the dollar CNH spot can reflect market expectations for yuan exchange rate. Offshore CNH liquidity conditions is important because if China's Ministry of Finance issue treasury bond in Hong Kong or central bank issue PBOC bills in Hong Kong, it will drain liquidity from the banking system. So then it will boost CNH exchange rate. There are also capital flows related issues like southbound stock connect flows. mainland Chinese investors won't buy Hong Kong stocks, so they have to convert Chinese yuan to Hong Kong dollar. So it will move CNH exchange rate. And yes, similar to onshore spot, China's fundamentals and the geopolitics issues are important for dollar CNH exchange rate as well. We give some figures. So as at end of June this year, foreign investors, they hold about Chinese equities about 2.7 trillion, Chinese bonds 4.4 trillion, loans 1 trillion, and deposit is 1.8 trillion. So it's general how much foreign investors holdings in Chinese renminbi assets. So the second event we would like to give some explanation is the upcoming U.S. presidential election. So in fact, it's Trump or Harris. According to latest market price, Trump got advantage in the campaign. Now it's a 64% chance to win, and Harris about 36% chance of win. So the major difference, what financial market is interested in is the corporate tax and trade policy. For Trump has said it tends to cut corporate tax lower to 15% from 21%. And for trade policy, Trump said it will go further, imposing tariff of at least 6% on China and 10 to 20% on the rest of the world. For the Harris plans to raise the corporate tax rate from 21% to 28%, and for the trade policy, he would follow the trade policy of Biden. So, generally speaking, Trump's policy may, and according to a quarterly survey conducted by Wall Street Journal, between 4th to 8th of October, roughly 60% of 50 economists think inflation, interest rate, and the deficit will be higher under policies Trump would pursue in a second administration than that under Harris. So that's why recently there's a call revived Trump trade. It's a higher treasury yield because market may worry about more inflation. And yes, the U.S.-China bilateral ties may impact dollar CNH spot. So we can see this chart. So when the trade war starts, dollar CNH will rise. Then once markets think, okay, U.S.-China will reach trade agreement, dollar CNH will trade lower. This is what happened in 2018 to 2020. And this time there's some difference. First of all, at that time in 2018, the Fed is in rate hiking cycle, but now Fed is in rate cutting cycle. And at that time, dollar CNY, dollar CNH is about only 6.2, 6.3. Now dollar CNH is already 7.1. So even there's trade conflict between US and China, I think the upward room for dollar CNH, dollar CNY is limited. Regarding the CNH exchange rate outlook, in general, we expect the CNH will advance moderately for the rest of the year with some two-way flexibility. And CNH has been appreciating since early July, particularly after the Fed kicked off its rate cutting cycle on 18th of September, and the PBOC unveiled a package of monetary easing measures on 24th September. And according to the IIF data, International Institution of Finance, and at end of June 2024, China's government debt amount to about 86% of the nation's GDP, much lower than roughly 120% level of the US. It suggests China has fiscal policy room to support economic growth. And the latest stimulus measures rolled out in China have improved market sentiment. And also, we put an interesting chart here. It's called FX settlement and sales ratio. It means the portion of export proceed is sold to banks. So according to the latest SAFE data, FX settlement ratio increased to 70% in September from 62% in August. So it suggests corporates and other companies, they would like to sell more dollars they earn from the international market. So which we are providing additional support to Chinese yuan. In the near term, I think CNH exchange rate will be influenced by broad dollar movement, portfolio investment flows, FX position adjustment, China's pro-growth policies, and macro data of US and China. Meanwhile, we keep watching US presidential election set for 5th of November. In addition, we note PBOC repeat in the first quarter MPC statement that it will prevent formation of one side and unanimous expectations to keep the yuan basically stable. So we expect Chinese yuan, as we just mentioned, to advance moderately in the near term. So yeah, that's all from my side. Today's presentation here is about the awards we earned. So we are willing to provide good service to our clients. Thank you. Pass over back to Mr. Song. Thank you.
All right, thank you very much, Aaron, for your informative presentation. I'm sure our audience has gained a lot of valuable insights into understanding the USD and CNH better. Now it's time for our Q&A session. So for those of you, if you have any questions related to our two speakers' presentation, please type them in the Q&A box so that I can easily capture and address them. While we wait for questions to come in, I would like to share ask a small favor from all of you. For those of you who don't have any questions, please take a minute to fill out our feedback form. Since our speaker have provided an informative session for today, it will take you less than a minute to complete. You can find the feedback form link in the chat box or scan the QR code with your smartphone. So take a moment to share your feedback. Will greatly help us improve our future sessions and ensure we continue to deliver valuable content that enhances your learning experience. So please take a minute to complete the form and we will begin the Q&A session shortly. Another 30 seconds to go. All right, a minute has passed. If you have already submitted your feedback, thank you very much. For those of you who haven't finished yet, feel free to continue. Now let's move on to the Q&A session. Now there are several questions here. Let's start with a question that is related to FCNH futures contract. So this is for Darren. There's one question asking when will Mumu start to offer futures trading in Malaysia?
All right, thanks for the question. They actually have started already, so if you're interested, do give them a shout and let them know that you want to trade futures with Bursa Malaysia. They're already a trading and clearing participant for BMD.
Okay. Another question also related to FCNH. In which currency will these FCNH futures contract denominated in?
It's denominated in renminbi.
Okay. So does that mean all of the profit and losses will be denominated in renminbi?
Yes, that's right.
Okay. Another question, whether there is a market maker for FCNH.
Yes, we do have market makers in place, and we plan to extend it up to next year.
Okay. Okay, there is a question that is related to the renminbi. I think believe this is actually for Aaron. Whether there are any differences between onshore and offshore renminbi.
Yes. First of all, as we mentioned, the important difference is onshore CNY has to trade between plus minus 2% around the fixing. That's set by PBOC, announced by PBOC at 9:15 a.m. Beijing time each trading session. But for offshore, there's no such restrictions. It's a freely trade currency. So dollar CNH moves more quickly or sensitively in response to any change in expectations for yuan exchange rate. So if market expect the Chinese yuan will appreciate, market will sell dollar CNH and sell dollar CNY, but dollar CNH will drop more and faster than dollar CNY, and vice versa. So I think that's the most important difference. And also, there's a central bank in onshore. There's no central bank in offshore. Yeah.
All right. Another question. This is for Aaron. For the benefit of those new traders who are starting out in currency futures trading, what are the key fundamental factors that traders need to pay attention when trading the USD CNH futures?
In my opinion, I think fundamentals is important. So at least investors, it's better for investors to know what happened in US, what happened in China. So and the monetary policy, whether the Fed or PBOC is in the same rate policy, rate hiking or rate cutting policy, or different, or whether there's some divergence between US and China, and whether there's any fiscal policies. Because, for example, during the pandemic period, right, both Trump and Biden, they roll out several bills to providing cash to U.S. household and companies, which provides support to U.S. economy. And as what happened in late September until early October, China also rolled out a package of stimulus measures, so which has improved market sentiment, enhancing investors' confidence. That's important. All this could move exchange rate, and this is how regarding analysis. Then I think another important point is risk. We cannot only pay attention to a profit. We have to watch risk. Bear in mind and set profit taking or stop loss levels and follow the trading rule strictly.
All right. There's one more last question. Because I don't see any question on my side. One more last question. Both Darren and Aaron can answer this as well. What makes FCNH currency futures uniquely different from, let's say, index futures and commodity futures? So maybe Darren, you can share your insights on that.
Yeah, sure. The difference I would say is more about the view that you want to take. So for commodities futures, there's a lot of factors that you have to pay attention to. Inventory, weather for CPO, like in different months there are different cycles. For index, what you're looking at is the top 30 companies in Malaysia. How are they performing? What's the outlook like for FCNH? You're looking at interest rates, monetary policy, and all those factors are different, and it depends on what you are most comfortable with in terms of your research and what asset class you're looking at. But the one thing that I do want to stress is diversification. So if you want to start, you can start with paper trading, try out different currency pairs. You can also try FCNH because now that you've learned from Mr. Aaron about how dollar renminbi works, give it a try. It all boils down to what you are comfortable with in terms of, what factors to research. So inventories, for commodities at least. For index, it's like the top 30, how they're performing. for currencies, have a look at monetary policy announcements. One of the reasons that you can look at.
All right. How about you, Darren? Aaron, what makes FCNH currency uniquely different?
Okay, I think first of all, I think the important is there's very big growing room for this product in Malaysia. So as we know, there's very close economic relations between China and Malaysia. And if we plot dollar CNH and dollar ringgit, the correlation is also very high. And back to July 2005, China and Malaysia give up the fixed exchange rate on the same day. So it also shows the close economic relations, and we believe the trading volume, the turnover of this product in Bursa Malaysia will grow markedly, significantly in the coming years. We do believe that.
Okay, I don't see any questions from my side. All right, thank you very much, Darren and Aaron, for answering our participants' question. Now, it's now time for us to conclude today's webinar session. Once again, I'd like to take a moment to introduce you about our upcoming webinars, especially for those who have missed the earlier announcements. And I want to take a moment to acknowledge that, some questions may be basics, futures knowledge in the Q&A session, as I see just now. In fact, Bursa Malaysia offers a series of futures trading webinars and online workshops specifically designed to address these foundational topics, because these webinars and online workshops are aimed to enhance your understanding and provide you with the necessary knowledge to navigate the futures trading effectively. And we encourage you to take advantage of these opportunities for further learning. Here we have the LLF Let's Learn Futures webinar series. It features a variety of topics scheduled every Tuesday evening from 8:30 p.m. to 10 p.m. And we cover a wide range of content-packed and informative topics, allowing you to gain practical knowledge about futures trading from our experienced speakers. So if you are interested in joining any of these sessions, simply scan the QR code to register for the topics that you would like to attend. Once you scan the QR code, you will be directed to a page where you can access to our event calendar. To join our upcoming sessions, you can simply navigate to the Tuesday column in the LLF webinar topics section. Click on the session you're interested in and proceed with your registration. In addition to the webinar, we also have the LLF online workshop. This workshop is tailored for those who are new to the futures market. So if you're interested in learning about futures trading in detail, then this online workshop is ideal for you. We'll guide you step by step on how to start your first futures contract. And to find the LLF online workshop sessions, look for them in the Saturday column in the event calendar. Click on the workshop session that you're interested in and proceed with your registration for there. And please note that each session is limited to the first 50 online attendees, so be sure to register quickly to secure your seats in both workshops. All right, we have come to the end of our webinar session today. Thank you very much, Aaron and Darren, for sharing such an informative session with us. And to all of you who joined us, thank you for your participation. We hope you found this webinar both informative and valuable, and I believe you have gained new knowledge in understanding the FCNH currency futures better. And with that, I'm CY signing off now, and enjoy the rest of your day. Good night and goodbye.
Thank you.
Goodbye. Thank you. Goodbye.
Thank you. Goodbye.